Let's take a look at the RPAR ETF. We're going to start with an overview of the fund and then take a look at the portfolio composition. And then I'm going to show you a backtest of the fund compared to a 40/60 allocation fund and Ray Dalio's all-weather fund. And then I'm going to show you how you could replicate the RPAR ETF with ETFs at a lower cost, about 40% lower in expense ratio, including with the leverage. And then I'm going to share my final thoughts on the portfolio with you. So here we go. Starting from the fund's documentation, we can see the words risk parity right at the top of the page, right next to its ticker symbol. So if you read it, it's RPAR Risk Parity ETF. Obviously, this is a risk parity ETF, and that's kind of implied from the ticker symbol RPAR. I know when I looked at that ticker symbol or saw it for the first time, I'm like, ooh, this is a new risk parity fund. It was launched on December 12th, 2019, so it's been around for a little over 2 years now. Right now, as of recording this, it's January 11th, 2022. And total assets under management at $1.61 billion with an net expense ratio of 0.51%. I have to say that's a pretty sizable AUM for a fund that's, not coming from a major fund issuer like BlackRock or Vanguard. Now, in the fund description here, we can see in the first sentence, it says, the RPAR Risk Parity ETF seeks to generate positive returns during periods of economic growth, preserve capital during periods of economic contraction, and preserve real rates of return during periods of heightened inflation. To me, that's just ringing bells of Ray Dalio's all-weather portfolio. Why invest in RPAR? Well, it provides access to a time-tested risk parity methodology used by some of the world's most sophisticated investors. It's implemented in a tax-efficient liquid ETF structure, and it seeks an equity-like return with less risk over the long run by diversifying across 4 asset classes, each with unique environmental biases. So what is risk parity? Let's just kind of cover that in case anyone watching this is unfamiliar with it. Risk parity, the concept of it is basically selecting a basket of asset classes and then weighting them to achieve the intended risk-return profile based on their volatility, right? So it's going to hold, less of more volatile assets and hold more of the less volatile assets. So basically, it's going to kind of take a group of asset classes and weight them according to their volatility, according to their historic volatility and their risk-return profile to ultimately maximize the risk-return profile. And then commonly when you see these types of risk parity strategies, there's typically leverage involved because now what you're doing is you're controlling the downside risk. Therefore, you can safely lever up that strategy. And I think that's what we're getting into here with RPAR. So what does the RPAR ETF hold? Well, we have this chart right here that shows the target asset allocation of the fund, and this one over here, which has the target risk allocation of the fund. So what this tells me is that they're trying to get or intending to get this exposure, the risk to this portfolio with this asset allocation here. Now, here's what's interesting. If we do the math on this, 35%, we're at 70, plus these two, which is 25%, and then these two, another 25%, it's 120. So this fund is clearly using leverage in some way. And I'm guessing what they're doing on it here, and it's kind of implied by this little statement, is they're leveraging up the bond portion of this. So 35% tips, 35% treasuries. I'm thinking, my gosh, 70%, that 70% allocation of what is basically fixed income seems outrageously high to me. 10% to gold, which is basically a go-nothing asset class. And then commodity producer equities. This is really weird, right? Like why commodity producer equities when you could just buy commodities? I'm not really sure, and I don't really see a reason to hold the commodity producer equities. If anything, this kind of gives you more of a correlation to the stocks because these are equities themselves, they are stocks. So it's giving you less correlation to commodities and more to stocks. That just seems a little odd to me. And then global equities, 12.5% US, 5% international, 7.5% emerging markets. So 12.5 US, 12.5 foreign stocks. That's a little bit more foreign tilted than most balanced funds are providing these days with the, the kind of rampant growth over the last 10 years of US equities. Nearly all balanced funds are heavily tilted towards US equities. So this is kind of evening it out. That's interesting. And then yes, if we come here to this one, we can see the target allocation of the fund is blah, 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 blah. I was really interested in this line. The 120% total allocation references 20% of leverages at the portfolio. This mix results in roughly equal risk allocation to each of the four major asset classes: equities, commodities, tips, treasuries. So that's basically telling us the same thing as it showed here. So let's open up a backtester and take a look at these. I put them in here, and we can see we've got the allocations. Oh, and I grossed them down, or I netted them down. I basically took out the leverage, right, and adjusted for the leverage to get them to equal 100. For the sake of this, we'll lever it up in a second. But we can see the portfolio value, against a 60-40 portfolio. It's, or 40-60, excuse me, I've got 40%, what am I using? Yeah, VSCGX, that's a 40-60 portfolio that's in here. We can see the risk return profile of it over time, and it's, basically about the same, actually. Look at that, the Sharpe ratio is about the same. There is a drawdown here. It doesn't draw down as much as that 40-60 portfolio does. One thing to point out here is this flat period, right? So from like 2013 to what is basically 2019, 6 or 7 year period here, the return of this portfolio is basically flat. And I think this is a lot to do with commodities were probably going pretty flat at that time, I know that. And foreign stocks really went nowhere good through this time, and certainly not emerging stocks or emerging markets. So foreign developed didn't really do much, emerging markets didn't. So you have this period here where, the broad balanced portfolio, Vanguard's 40-60 fund, is growing and yours is not. So that is one thing I don't like about it. Now let's put some leverage on this here. Let's leverage it up 20%. When you leverage it up 20%, it kind of starts to outperform. And mind you, the leverage ratio here that I applied, actually, I'm not sure. I was going to say that applies to the underlying holding. All right, so 5.59. So when you lever it up, when you lever the holdings up, yeah, right now you start seeing some outperformance. But again, your Sharpe ratio doesn't really go up that much. Your annual growth rate goes up about a little over 1%, 1.25%. You've still got that period here, and you really can't change that between 2013 and 2019, where things are flat. And your annual return of 6.76%. Interestingly enough, let's put the all-weather portfolio on here by Ray Dalio. Actually, Harry Browne's Permanent Portfolio would be a good one too. We'll look at that. We'll look at that as well. So we'll just put Ray Dalio on there, and then that Harry Browne Permanent Portfolio. What is that? Yeah, that's 25% US stocks, 25% gold, 25% long treasuries, 25% cash. Now, with the cash, that portfolio is probably kind of getting crushed. So here's portfolio one. Portfolio one is our portfolio here, and that's replicating RPAR. And mind you, I didn't use the I didn't use the commodity producers, right? So this is commodity producer equities. I just used basic commodities in here because that was easier to test with. But when we look at them here, we can see that the all-weather portfolio by Ray Dalio with 20% leverage is up 8.99% and has a max drawdown of 19.02%. And then the permanent portfolio up 8.23 with a max drawdown of 16.71. That one actually did better than I expected. Let's just take out the leverage real quick here and look at the numbers. Yeah, so the all-weather portfolio naturally with the leverage, the annual growth rates are still going to kind of stack up in the same order. In this order being all-weather portfolio, permanent portfolio, and then finally the RPAR ETF. But both the all-weather portfolio and the permanent portfolio have had a higher return over this period of time. And without leverage, what is it? Yeah, without leverage, they both, or all three of them, do slightly outperform it. Now, one reason why I think the two other portfolios here, which is going to be permanent portfolio and all-weather portfolio, outperform, is if we look up here, we can see they don't have any allocation to foreign stocks, right? So they're purely U.S. stock equity holdings. So they're kind of fitting a perfect time frame here when U.S. stocks have really cranked things up and outperformed over these last 10 years. So they are kind of benefiting from the fact that they don't have really any downside, or they don't have the, I don't want to say the downside, but they don't have the kind of go nowhere effect that foreign stocks have pulled out of equity markets over the last 10 years. So yeah, if we put the 20% leverage back in, we can see things. Now, one thing I always like to say is it's not really fair to look at a strategy just in context of, hey, I put $10,000 in back on this date, which is what this tool does, at least as we're using it now. What about if we're constantly investing over time? Because that's how most investors invest, or you should be investing, is contributing a little bit each week or each month. Very rarely, unless you're in the retirement phase, are you just saying, hey, here's my lump sum portfolio, what's it going to do? But a lot of people get stuck on this number of, hey, I would have put 10,000 in and this is what it would have done. But more realistically, let's just add a cash flow, contribute a fixed amount of, let's just say $1,000 a month. I don't like doing the inflation adjustment on it. I just like using the raw numbers. All right, here we go. I had to refresh my screen there. But if we come down here, we can see the balance of investing $1,000 monthly along with a starting balance of $10,000. And we can see that our RPAR strategy had a final balance of $334,000, while a 40-60 portfolio had a final balance of $328,000. So they came pretty close, much closer than when you're not dollar cost averaging into them. And that's because when it's got the dips in it, if we take it out of that doesn't really show it any better on that. But if we buy the dip, so to say, and we're constantly investing in, we get more opportunity when there is some drawdown and more volatility, because ultimately we're going to buy in at lower points. And then of course we've got the all-weather portfolio up here, turning a total balance of $423,000, big difference there. And then $381,000 for the permanent portfolio. So, even with the 20% leverage, the strategy during this period of time, it's very important that I say that, because this is really just a small period of time in history from 2007 to now, so about 14 years, 15 years. Over this period of time, even with the leverage, just a basic old 40-60 balance portfolio would have gotten you damn near the same place. Now let's talk about how we could replicate the underlying asset allocation strategy of RPAR with ETFs and do so at a 40% less fee than the net expense ratio of RPAR. These are the ETFs I would use, starting with VT, Vanguard's Total World Stock Index. I chose this as an all-in-one solution instead of holding individually the international, developed, and emerging market portions. And then GNR, that's a Global Natural Resource Equity ETF, SGOL for gold. TMF, this is triple leveraged long treasuries. We're going to use this to get leverage on the portfolio, specifically doing it through the long treasuries portion, and then LPTZ for tips. Now, with this triple leveraged TMF, to get that 35% exposure, we can use that to basically, to get that 35% exposure, this is complex to say, to get that 35% exposure to long treasuries, we can reduce that to only 1/3 of that in our equity allocation using TMF. So here on this pie chart, you can see that it is at 12%. Now keep in mind these numbers are rounded. I rounded them to the nearest percent just for creating this chart. But you can see some of my math over here. Anyways, 12% with TMF is basically getting us 36% to long treasuries. It's not getting you exactly that. Keep that in mind because it is a leveraged ETF, so it resets daily, right? And then in doing that, we can redistribute the excess over the rest of the portfolio, and this effectively gets us about 20% leverage on the portfolio. And here are the the weightings that we would do it: 10% to gold, TMF 12, 36% to long treasuries, 26 to total world stock, and then 15 to GNR. And this would get us pretty damn close to the RPAR ETF. Keep in mind, it will not perform exactly the same, but it will be very close, very similar. And the expense ratio, when you kind of weight these all out in the allocations using the expense ratios of the fund, you would be at a 0.297% expense ratio. Compare that to what is a net expense ratio on the RPAR ETF of 0.51%. So that's how you would do it, guys. So what are my final thoughts on the RPAR ETF? Well, I like that it does this entire strategy in an ETF wrapper that's incredibly tax efficient. But looking at it here, one thing that really jumps out to me is it's only got 25% allocation to equities, when equities have been the highest returning asset class beyond inflation throughout history. And then it's also got a really high allocation to treasuries, yet, at the time period we're looking at historically, interest rates have been low, and going forward, and this has just been in the news the last week, the Fed is planning to raise interest rates. And this also comes when bond yields are at their lowest. So we've got this environment where, looking back, treasuries have done great, but there's no rule that says they're going to do great in the future. And with the way things look, they're kind of in a position to do worse and, perform poorly or underperform their historic performance going forward. And then, we've also got this market tracking issue, right? And I think it's very difficult for investors to stick with their portfolio or their strategy when they were underperforming the market. And we would have had that here if we, I'm not going to clear those off, but this period here between 2013 and 2019 would have been a very long, painful 6 or 7 years when everybody else is making money, but you are just sideways and flat. So, I really don't like that about this strategy. Granted, that could happen in any strategy, but it's very difficult to sit through a flat or underperforming or negative performing time period when basic allocation market beta is actually going up. And then you've got the allocation to commodities, which has the commodity producer equities in here. I find this incredibly weird, and I don't know why they wouldn't just hold commodities. Why would they hold the equities when these are more correlated with stocks? And you could just hold the commodities and less correlated with equities, right? It just seems weird that that's here. Maybe that is to give some more to equities than the global equities portion is at 25%, as I'd kind of observed. And then finally, with risk parity strategies like this, they take a big haircut off of the upside, often in exchange for some downside protection. But I really don't feel like that downside protection is worthy, or I don't feel like that downside protection is worthy of what you take off of the upside. It's like going on a 5-mile hike, but carrying enough gear with you to last for 2 weeks or something like that. And then, of course, we can see here comparatively to other risk parity types of strategies, like in this case, I use the Ray Dalio all-weather portfolio and then the Harry Browne Permanent Portfolio. They perform differently over different periods of times. There's no rule that's going to say going forward the all-weather or the permanent portfolio is going to perform better. But there's also no rule to say that the RPAR strategy is going to perform well too, or perform as well as it has. So for that reason, I'm really not a big fan of risk parity strategies, and I really can't say that I'm a big fan of the RPAR ETF. What do you guys think of RPAR? Let me know in the comments below.